The week before was dominated by the Fed and what it would do to all markets. But this week has been dominated by Asian central banks. The BOJ has sounded less hawkish than was expected. And the Chinese central bank, the PBOC, has surprisingly cut more than expected. So there is a lot to discuss on rates, commodities, currencies, and what it can do to, of course, the Indian economy and Indian stocks. Joining me are two experts from JPMorgan. We have Jahangir Aziz, who heads emerging market economics, and Luis Oganes, who is the head of global macros, commodities, currencies, and rates at JPMorgan. Luis, Jahangir, thank you very much for joining me.
Thank you.
Well, let me start with the big announcement from China. Was it more than expected, this 20 basis rate cut and promises of more cuts? What does it do to the Chinese economy?
So there are two separate questions. So the first question is that was it expected? It was more or less expected, right? But you have to look at the two of them separately. The 50 basis points of RRR cut, that was meant to create enough liquidity for the Chinese government to continue to issue bonds, because that was a basis on which we had called for a 50 basis points of rate cut. The 0.2% repo cut, that was tad higher than what we had. We had a 10 basis points of cut. But again, the amount and the timing of that was always quite uncertain. Clearly, as you pointed out in introduction, the Fed cut of 50 basis points is having an impact on emerging market in Asia. Asia was the place where you did not have enough amount of cushion with the Fed, and that was where the concern was, that these countries or these current central banks could not cut without triggering concerns about and financial stability. I think the rate cut by the Fed has opened that space, and I think you will see other central banks follow. BI was the day before, yes. And BSP is probably going to be adding more rate cuts. So I think that the overall idea that the Fed, intransigency over its rate cutting cycle and making us wait for quite some time, was holding back
the central banks
in Asia particularly, not in Latin America or other places, is playing out to be true.
Okay, before you analyze the impact on the Chinese economy,
sure,
which we are all terribly interested, just to complete the argument, does this make it more incumbent on the Reserve Bank to act, at least from the currency angle? Because if there are so many cuts and the Chinese central bank also cuts, rupee appreciation will be uncomfortable.
So I wouldn't bring FX directly into it, okay, because obviously, RBI has a, very ambivalent attitude towards what it does to the rupee, insisting that it only smoothens out volatility. But clearly, they have a view about where the rupee goes. But I would say that it's much more domestic driven, the need for RBI to cut. So if you have an economy, and let's not go into what recorded growth is or not growth is, let's look at the proof of the pudding. The proof of the pudding is core inflation. And core inflation today is at its lowest level since the inception of the index in 2012. And it has been falling over the last 9-10 months. I've lost count of that. In any country where core inflation has fallen to this low level, and it has been actually falling on a sustained basis, it always smells of serious excess capacity in the economy, and not only excess capacity, but widening excess capacity. Okay. You can have core inflation falling 1 month and then go back at other, and then you can say, well, it's something else that was working. And but 9-10 straight months to its lowest level in 2012. Okay. So I think that it is incumbent on the RBI, just like the Fed did, which is that we need to recalibrate, okay, the restrictive plan. Nobody's asking them to be...
So you're calling for a December cut or an October cut itself?
So my India team does not have an October cut. They say that in October they will change their language, okay, and then there'll be December cut. I'm probably on the side that, why change the language only? If this was a 25 basis points of cut by the Fed, then I would say, yeah, change the language and then go for a December cut. It's a 50 basis points of rate cut.
Okay. So, Luis, to come to that, Do you think the Chinese disinflation recedes somewhat if the rate cut recharges that economy?
I don't think that that is going to recede anytime soon, because the problem is that China has a problem of excess supply right now because there is not sufficient domestic demand. There is still a problem in the real estate sector, which demands a lot of steel, to your point, or other commodities. And the solutions to that are not, anywhere to be seen. And we know from experience of any country that has had, boom-bust cycle in the real estate market, it takes time for these cleanups to happen. So what China is doing is obviously, keeps manufacturing and keeps flooding the global economy, global markets with its, cheaper production. Yeah, that has been generating a lot of reactions, right? U.S., Canada, EU, you name it, imposing restrictions, some tariffs or protesting, this attitude. But China is not, they see it to their benefit. Yeah.
Yeah,
so
exactly.
I think that this disinflationary impulse from China, in my mind, is going to continue.
Is not going away anytime soon.
No.
Okay. Just a word on the Chinese currency as well. It has appreciated from around 7.3 a couple of months ago to 7.03 now. Do you expect all currencies have, like the rupee has. What's your sense about the yuan itself? Will it depreciate more because of the inherent weakness?
I think that the path in our mind is more for depreciation, but there as well, to the extent that it is a currency that is heavily intervened, right? And
yes.
and the reality is that I think that at this stage, probably the Chinese authorities don't want to add insult to injury, promoting more currency weakness than what is strictly necessary, needed, but. Growth weakness, interest rate cuts that you're discussing here, all that points to less support for the currencies.
What about the Chinese economy itself, Jahangir? You said that the 50 basis, the CRR cut or whatever, triple R cut, is to give space for fiscal stimulus. With a bit of more fiscal stimulus and this monetary stimulus, are you any more confident?
Look, so we have been continuously disappointed on the lack of change in the direction of policy. As Luis was saying, it isn't so much you need more quantum of fiscal stimulus. You need the fiscal stimulus to be in the right place. So China is facing a problem where domestic consumption has been continuously disappointing. On the other hand, if you look at fiscal policy has not provided any support to domestic consumption. Fiscal policy continues to push in towards more production. So if you have more fiscal stimulus that goes into fueling more production, then exactly what Luis said is going to happen, which is that the excess capacity increases.
Will again come to the export market.
And the Chinese will have to find another market outside of China to sell their goods. Deflation is a serious concern in China, not just deflation in export prices, but also deflation internally. So we have been looking for a shift in the policy direction, not
towards consumption.
Towards consumption, whether it takes the form of income transfers, whether it takes the form of more support to low-income housing, to public housing. That's the change that we have been looking for. And unfortunately, we've been waiting for a long time for that change, and that change hasn't happened.
Okay. Fine. Let me shift to the other major Asian country which has suddenly loomed in terms of importance in currency markets in particular. What's the expectation from Japan? More hikes?
Yes. So we have to understand that what has happened in Japan is not a fluke. It is not all of a sudden that inflation is coming back. Japan did take significant amount of structural reforms in the past 2 years, and the result of all of that is that Japan finally is seeing inflation going up, wages going up, and that is being done with concerted government effort. We have a rate hike in December, but we have 2 more rate hikes in 2025.
Oh.
Market only has 1 rate hike right now priced in. So our view, and Louis, correct me if I'm wrong, is that if you get these 3 rate hikes rather than just only 1 rate hike, which is what the market is pricing, the yen appreciation that you've seen more likely has more legs to go on. And the argument, and just to connect to the previous point that you were trying to make about why CNY appreciated, the first leg of that appreciation, not the second leg, but the first leg of the appreciation was the unwinding of the yen carry trade.
Yes.
So that did have an impact. So in our mind, we are significantly above the market consensus in terms of where BOJ will go. And if that's the path, then my guess is that, currency is probably headed towards more appreciation rather than depreciation.
But before I take a break, the most important question which our viewers will want to know, where is the yen headed, and is there a chance of a repeat of the yen carry trade unwind which hit us in early August, or these things don't repeat really because the world is prepared?
The projection that we have is that the yen is going to be, potentially crossing, piercing again the 140 level, going to the high 130s. Okay. But this assumes a U.S. going into a soft landing and nothing dramatic happening around the U.S. elections. If we get a U.S. recession scenario, it is possible that we actually get more rate cuts by the Fed. It is possible we get to the low 130s or even the high 120s. This is clearly not in the market. As Jahangir said, our team expects more hikes than what the market is discounting right now. So if you speak to JPMorgan traders, dollar yen is a currency, so the yen is a currency that they seem to favor, just because it is still not consensus. People are not convinced that these inflation dynamics are here to stay, that the policy path for the BOJs for more hikes, this is still, not everyone is believing it.
Okay. Well, we have to take a break. 2 key conclusions or inferences I can draw is the Chinese disinflation is not over. We better watch out. And the yen carry trade unwind story also may not quite be over, especially if the US has a little more recession than what the market's prepared for. We have to take a break, but many more interesting questions, especially on the India growth story, to our guests after the break.
So when we say melt up, I just want to sort of finish that point. It usually we are talking about like a frenzied move in the very short term, but that's not what you mean. You think
it makes a major long-term top, which is not a great thing. So it's great that we are going up on a wall of worries in a way that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets don't climax at periods like that. And this seems to be more like the 90s bull market, where small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. And B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up, where the entire market goes up 10x in a decade. And then you don't see that prices for maybe next 10 or 20 years. So I'm hoping we don't get a melt up, and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4.
Welcome back to this very special edition of Indianomics, where I have two guests from JPMorgan who are experts on Asian economics, and of course Luis, who's an expert on global macros, commodities, rates and currencies. Jahangir Aziz, of course, we know very well. Jahangir, let me come to the India story. Exports have been reasonably helpful to us. Do you think the growth story, which is kind of hovering between 6.8 and 7, can get impacted by what's happening globally? Would you bet on a 6.8 to 7 growth?
No, I would even bet on a high growth rate. If oil price falls to $60 or below that thing, just because that's the way CSO measures growth, but deflating 75% of nominal GDP by WPI, you can get 8. I mean that is not the issue. I think the issue is that for at least 2-3 years now, we've been running essentially on 2 engines of growth. One has been public infrastructure, and the other has been export of services, not export of manufacturing. Those two still remain the only 2 engines of growth. You look at the budget, look at what the government policies are, look at even the design of infrastructure that has been proposed. It is again geared towards keeping just those 2 engines of growth. So you have to tell me how long will these 2 engines of growth will last. So the first engine of growth, which is in the hands of the government, which is public investment, will continue. This budget still has a significant amount of public investment planned. In addition to that, the state governments have also joining in hands with the central government. So I'm reasonably comfortable that the public investment part will continue. That leaves you with the other engine of growth. The other engine of growth is export of services, and that's where I think the concerns about US comes into play. I don't think that a recession by itself is bad for the expansion of global capability centers in India. That is the basis in which the export of services has been going on.
Yes.
I think it might actually even further that's almost like a recession trade that you do. That if you go into a recession, then you would want more of your back offices, more of your support services to be located to a lower cost center rather than a higher cost center. So even if there's a recession, I think that part of the services sector story remains pretty much intact. The question then is that are those 2 drivers of growth sufficient? Do we really need to broaden our drivers of growth? Obviously we do need to do. You can't just run an economy in just 2 drivers of growth. The driver of growth that we have been waiting for since when? 2012, private investment, we're still waiting for it. And that's where the key concern is, that after 8, 9, 10 years of waiting for it, why are we still waiting for private investment to come back?
The more important currency commodity questions to you, Luis. First is the dollar index. It's shied off 100, taking support over there, but should we be prepared for much lower levels? The JPMorgan expectation is 5 cuts, 2 already delivered.
I think that we need to watch very closely the next couple labor market reports. I think that the U.S. labor market is going to be what determines how much more the Fed cuts. Our U.S. economists still have 50 basis points for November,
yes,
and then 25 basis points subsequently, taking the policy rate from 5% where it is right now to 3% by July next year, right? But the pace of that depends on how dramatic the labor market deterioration is. So let's see. We're all going to be in data watching mode. But I think that what is clear though is that the Fed is feeling sufficiently comfortable that the balance of risk between growth dynamics and inflation dynamics is more balanced, and they call it we're recalibrating.
So
right?
you don't see a sharp dollar index fall?
The dollar index, in the current scenario, as you know, the dollar already peaked. It has been moderating. It has been falling, partly because of the expectations that the Fed will cut. Now the Fed has cut. It has delivered on that. And the expectation, generally speaking, that the U.S. economy is going to fall into what we call a soft landing. That combination, soft landing plus lower rates, should go actually against the dollar and allow it to continue to moderate. EM currencies, you guys are feeling it here in India, should appreciate against the dollar. But let's also hold our breath there, because if the Fed has to do more, because we're actually getting closer to recession territory, recession risks, that would actually at some point flip the dynamics for the dollar. The dollar always tends to appreciate in the initial phase of a recession because of global deleveraging and because of flight to quality into U.S. assets. So, again, we're holding off on discussing U.S. elections.
Yes.
Everything that we hear about that points to a stronger dollar as well, right? So I think that it is a little bit of a dicey moment for the U.S. dollar, where fundamentals right this minute are pointing to further depreciation of the dollar.
The one that's under-discussed is the U.S. fisc. Neither of the parties are speaking about lowering the fiscal deficit.
Right.
So do you think that has some implications for the U.S. yield curve? Even if there are cuts, the 10-year doesn't dip much.
So,
what are the implications?
So I think the 10-year is pricing in continued large issuance, at least for 25 and 26. So as Luis said, a lot of policy changes can happen. Some of the policy changes that can happen are immediate. Some of the policy changes will take a long period of time, and it will also depend upon what is the composition of the Congress. And the ones that will take a long time and will depend on the composition of Congress is what is going to happen to fiscal policy and what is going to happen to deregulation, what is going to happen to the structure of the Fed. Let's not forget that in 2026, the large portion of the Fed, including the chairmanship, comes for renewal. But those are things that will happen, probably take 25, and probably we'll see that in 26. In 2025 per se, if we get a divided Congress, chances are that because you'll have to go into a reconciliation between the Senate and the House, it is very difficult to see that the U.S. continues to pump in very large deficits, unless you get into a recession.
Deficits may come under control.
Deficit almost mechanically falls because there's a reconciliation, right? It will almost make sense, but it is not a very large fiscal drag. Okay. It is a modest fiscal drag. I think, as Luis was pointing out, and something that we should be talking, and I'm guessing the market will start picking on, is that immediately you will get the tariffs and immigration and the impact on immigration. Both of them are seriously inflationary for the U.S. economy. And don't need Congress support. And by the way, the market is going to price that in on November 4th. They're not going to wait for January to read the tea leaves, right?
But Luis, there is a lot of interest in commodities now. Where do you see crude headed? And equally important, where do you see base metals like copper and aluminum headed?
So, oil, supply-demand has been rather tight. The balance has been rather tight in the last couple of years, and this has been because there's been quite a bit of an increase in non-OPEC supply that has been matched in terms of cuts by OPEC plus countries, particularly Saudi Arabia and most recently actually Russia. Yeah. That has allowed oil to remain in a range of 70 to 80, with some exceptions during particularly short periods of time. But because we are expecting supply to continue to increase by non-OPEC producers, including the U.S., including countries like Brazil, like Senegal, like Guyana, Suriname, the question here is, are OPEC countries, particularly Saudi Arabia, going to be willing to continue to lose market share in order to keep cutting production in order to stabilize markets, or are we reaching their degree of tolerance? At this stage,
So what,
Arabia is
$50?
producing. So we are, our own forecast is looking at prices in the low to mid 60s by the end of 2025, in the fourth quarter of 2025. This does not include anything, again, about the U.S. elections. So I would say that on oil, which is actually very supportive for India, you know, the outlook is for lower prices, right? For metals, the picture is a bit more mixed, and I would say that copper is probably the one where we hold the most optimistic view, even though most recently there's been a downward correction. A lot of this correction has been honestly driven by profit-taking from financial investments in copper, meaning ETFs or financial contracts, and the trigger has been the weak Chinese data. What is interesting, though, that the demand from China itself, they seem to be price sensitive. So during the rally, they stopped buying, and in the last few weeks, when prices collapsed, we have seen them come back to the market to buy. So we saw the peak earlier this year, $11,000 per metric ton of copper. We're now in the 9,000s. We're actually expecting the 11,000s to come back. Something not too different, honestly, is what we're expecting in aluminum. What is more interesting, that is also matters, I think, a lot here in India, is gold.
Yes.
Gold is where we have a very bullish view, and this is because apart from gold being used as an inflation hedge before, right, and being used as a way of insulating the possibility of more geopolitical events and sanctions and the weaponization of the U.S. dollar. Now we have the Fed cutting, and there is this inverse relationship. When real rates in the U.S. go down, oil prices tend to go higher. I think that our team has, projections, maybe another, 10–15% increase on average between this year and next year. So that's an interesting number. Right?
Okay. Stock markets everywhere, especially in India, are like reaching out to the skies. Anything hidden in plain sight in the form of red flags?
So the red flag for me has always been the case that in the emerging market world, there had been one leader who had the size and the breadth to absorb very large inflows of equity flows, which was China. You've taken China out for its own problems in China. We now want to relocate money from Chinese allocations to MSCI. India is already ahead of China. But in the rest of the emerging market world, there is no space. There's only space in the US. If you bring in even 1–2 percentage points of the allocation that made into China, into India, let's say, you're immediately going to run into overvaluation concerns. And that will stop the trade out. I think that is where my concern is, that you just might get stuck in this equilibrium where nobody wants to move, but because nobody can move.
Yeah, but as experts tell us, valuations are never a good enough reason for the market to fall, which is why we are looking for whether there are other flags. In any case, I think the big story is that gold is headed for greater highs. Thank you very much, Luis and Jahangir, for speaking with us.
Thank you for having us.